Yes, Mohammed, we can start inviting speaker, please.
Sure, Alim. First of all, Assalamu alaikum, everyone. And thank you all for attending this meeting. Starting with, of course, welcoming everyone and greeting. Good evening, ladies and gentlemen. This is Mohammed Al Muehi. I'm the VP for Strategy and Development of the AACE KSA section. On behalf of the section board members, I warmly welcome you all to our fifth technical webinar of this cycle. Our today's speaker for the webinar with the title Construction Cost Planning and Reporting will be presented by Engineer Mohammed Majid Hijazi, who has experienced project manager consultant with more than 22 years. Expertise in mega projects and multiple international certification, including MRICS and the PMP, CCP, as well as P3EO. We also carried all professionals and top management senior sponsored their employees for upcoming CEB and CCP certification courses. Thank you once again for joining us for this technical webinar. And we hope this session will add more value to your professional excellence. With no further ado, I turn the mic to you, Mohammed. Please go ahead.
Thanks for the kind introduction and the invitation. Thanks for having me, and appreciate all your efforts and all the team, and welcome for the attendees. I'll start now sharing my screen. Bismillah. Okay, so it's clear now, screen, everything?
Yes.
Audio,
Yes,
video,
I can see the screen. Go ahead,
everything is
please.
okay? Somebody's saying I can't hear you. Is it okay? Do you hear me? I think.
Yes, very okay. We can hear you properly and see the slides properly.
Okay. So today we are talking about construction, cost planning and reporting. So it will be like a overview for cost management, focusing on cost planning, budgeting, cash flow, and reporting. This is about me. I have Master in Construction Law, Master of Business Administration. I'm civil engineer consultant from Saudi, and a few credentials and certificate as introduced. The content will be starting with introduction, then cost planning fundamentals, risk and cash flow, reporting, how to make regular reporting for cost reports, and forecasting. And we will go also quickly about the simple example from cost control, earned value, and the total cost management framework of ACE, and practical challenges. Introduction for cost management. To have successful cost management, we need to start from planning, to have cost planning, to have a plan before starting execution. And this plan starts from the scope definition, and based on this scope definition, we can do the cost estimation, and this will be like the target and the basis the cost baseline we will use after that for during execution for monitoring, reporting, and cost control. And in this regard, we'll discuss how to develop a budget to be aligned with the schedule and to manage the cash flow. So in a summary, this starts from estimation, budgeting, cash flow, forecasting, and then control. That's why we'll go through these main items and fundamentals. To start with cost planning, you need to have a cost baseline in place. To do this cost baseline, will start with the estimation. And to make estimation, you need to know what are the classes and types of estimation based on the definition of the scope. So we start from the scope baseline, and this scope baseline will include like the scope statement, what is the scope definition, what the components, what the level of definition we have. We have everything in details, or we'll have like high level of the scope definition. So we can have like breakdown the details, the resources required, contingencies, and different types of reserve to have a cost baseline and budget in place. Then during the execution, we will start doing cost reporting. We report the financial status of the project, the current status, the remaining, how the remaining will perform, and based on the remaining, we can do forecasting for the estimate to complete and estimate at completion, comparing to the budget with reconciliation for what the actual work done and what is actually the expenditures. Then we do control. Control is to take the appropriate action, and if we have like some variances, some issues needs corrective actions, to do this action, and to do this action timely based on the reporting. So the reporting is not an objective from itself. The reporting, we do reporting to do any corrective action, to check the status of the project and to do any corrective action accordingly, avoiding going to like cost or budget overrun. To have a baseline, we said we'll start from the estimation. We need to have comprehensive estimation, and to have this estimation, we need to check the resources like labor, material, equipment, with all associated costs to each type of these resources to be checked and added to the cost baseline. And we add also the risk and contingency for the known unknown and unknown unknown, as we will see, to reach a budget and to have a budget in place. While we are doing estimation, it's important to check with the market, with the historical records, and validate the calculation by the market. What is the basis of our estimate? For example, here we have from ACE recommended practice for basis of estimate to record all the assumptions, what we do during estimation, and to compare with the market with our historical records. And historical records may need adjustment, like we did similar work before but in a different project. So what was the difference in timing, different in location, difference in some specs and requirements. So we will use this benchmarking with adjustment. We can get some data from our historical records or from the market, like a starting point or benchmark to compare what we did in our estimation to validate this estimation. We have different estimation methods, as I mentioned, based on the scope definition of the project. Sometimes we are still in the feasibility study. We don't have all details and all like quantities or measurement of the project. So we still have like high level of definition. But we need also in this, from this situation or from this early stages, we need to have cost estimation for the feasibility study and like the decision go or not to go for this project. We have 5 classes for the estimation based on the cost estimate classification system from ACE, starting from class 5 going to 4, 3, 2, 1. Class 5 is the high level. They are calling, we have 2 groups of the estimation approaches. The first group, the conceptual estimation. This conceptual, we have different approaches under the conceptual. It can be factored or units estimation based on the number of the units, based on the, like we are doing a hospital and we have the number of rooms, number of beds. We are doing parking and we have a reference of parking slots. We are doing hotel with the luxury level, the stars, the number also of rooms. We can have like sometimes doing villas. It is based also on the luxury level with built up areas. So we can have like factored from we have doing factory, and we have the cost factor from certain type of equipment, the main equipment. It can be like ratio from other estimation. We may do parametric estimation. We may have not only one factor, we may have multiple factors affecting the cost of this type of project, and some of them are affecting the cost in linear and non-linear, and based on the historical data we have, we build our equation to use after that for the estimation. This is called parametric estimation. So we can do so and check the correctness also of this, and what's the error margin of this equation, and we keep enhancing our equation. So these conceptual methods may be like quick, we can do it quickly in implementation, but it takes time to collect the data and to prepare our historical data and our equations. But the calculation itself, it can be done quickly. The other approaches are the detailed approach, and the detailed here is starting from class 3 semi-detailed approach. We don't have all details of the project, so we can do some details and calculate the others also from high level. Then the fourth level, we have all details, and we have more definition, scope definition of the project, so we can do the full detailed and deterministic estimation. The class 1, we have the full quantities. We can do all detailed takeoff quantities. Like class 2, we're doing takeoff but without all details. But in class 1, we have everything. We can do all the details of the quantities and calculate everything based on the quantities of the items and the resources, all resources required, temporary and temporary facilities, and everything required, including labor, equipment, material, overheads, and everything to calculate this. And also we can add the potential risk. If we are going to these resources and calculating the cost of each type of resource, we can find also many things affecting this. It's not only like we know the labor and the wages of the labor, like their salaries, and we divide their salaries by days, and we get their daily rate, for example, and calculating the cost according to this. We need also to know the productivity, what they are going to produce, or this they are calling productivity norms. And it's not only the cost of this production time, they have also paid holidays, they have like
Excuse me, Mr.
all different types of paid holidays should be
Excuse me?
added and considered. We have
Yeah, Mohandas
insurance, we
Mohammed,
have
hold on,
overhead,
excuse me.
we may have
Mohammed
composite
Mohammed,
crew from different
yeah,
types
Mohammed
of trades and types of labors, and we
Mohammed Mohammed,
have
excuse me,
calculating
Mohammed
like
Mohammed.
composite rate for the
Hello,
hourly
hello.
rate for this crew. Likewise, when we are
Yeah,
discussing
Mohammed
about
Mohammed.
material, we need to know the manufacturing type of this material as it's affecting it, because it's like
I'm not sure
doing
if he can hear
custom
anybody else.
type of materials,
Someone else
different
can talk
from
to him as well.
getting a material with big
Yes,
quantity you
yes.
can find on shelf.
Like,
So this, and with
yeah.
gross production
Okay,
or mass
fine.
production,
I will ask in the
the
end of
cost
the
of quality of the
the
material,
slide.
you are
Thank
getting
you.
the material to stores, and then you are shifting from a store, like have grand store or main store, and shifting to a project store, and then you are handling the material again. So you have cost for inventory, cost for handling, for the quantity. If you are purchasing like small quantity, extremely different from purchasing big quantity. You can get good discounts for getting bigger quantities from the suppliers. The inventory, you have different types of stores. You may storing some material outdoor, you store outdoor with some precautions. You need to store under sheds, you need to store in closed area. Some material you may need to store in air conditioned areas. So the cost of inventory is also different, and it can affect the cost of the material. The same with the equipment. If we are going to the equipment, sorry, if you can remove who is doing this, or so the cost also of the equipment and the production of the equipment, the productivity of the equipment needs to be considered. This equipment is rented or we are buying new equipment, what the depreciation over time of this equipment, its life cycle, the maintenance cost, the selling price, all these things needs to be considered. And the productivity rates, you can find many references for this, like RS means, and you have different references for these productivity rates. We need to stop this. Who's doing this, guys? If the admin can remove this, who's doing this drawings, please. After we are doing a cost estimate, we need to make a report for this cost estimate, because we did a lot of effort, we collect different data, we need to make a report after this. This report should include the source of data from where we got the cost or the prices of material, of labor, from productivity, the all estimation factors we used, all assumptions, the calculations, all of this should be done and included in this report. And like the basis of estimate, the details, the benchmarking, the backup for all data we used. And this benchmarking, we have here also guidance for benchmarking, and you can add benchmarking for all types of cost we use. We have cost for different types of resources, overhead, and everything we can also check from the benchmarking. Then after we have a good estimation, or robust comprehensive estimation, as we called it, we can get like robust budgeting. We can do comprehensive budget, and this budget also to be aligned with the time, and to be time-phased budget after that, and to be checked and monitored during the whole life cycle of the project. We start from the cost of every activity, and if we have any risk associated with this activity, can add cost to this activity. We call it contingency reserve, depending on the risk associated with this activity. Likewise, we get the work package for the WBS, the work breakdown structure of the project, and with the whole of this, we can, based also on the responsibility and organization breakdown structure, we can plan our cost accounts to use after that for monitoring the cost and reporting and control. And this cost estimate with the contingency reserve, it's called cost baseline. And we add other type of reserve, which is called management reserve, to get the project budget. What the difference, we'll see what the difference between the contingency reserve and management reserve. And this estimate, it is now converted to a baseline. This baseline, it will be aligned. We align this, we load with the timing of this activity, timing of the execution of this activity based on the project schedule, so we can know what's the curve. It's very important when we do this alignment with the project schedule. The project schedule is normally built based on the WBS, work breakdown structure, the scope, time-wise, when we are going to execute and implement these activities. While our cost normally is built based on the types of resources, based on bill of quantity, bill of material, bill of different types of resources. So we need to check this challenge and not mixing things together. So we can do like breakdown for the activities to assign to break down to the cost to assign to the relevant activities, or sometimes you can combine things together. Here also we have some formats, standard formats we use for bill of quantity, like master format. If people are working in like QS or preparing bill of quantities, may be familiar with the divisions of master format or new rules of measurement from RICS. And we need to, as I said, we need to do this sometimes to divide some bill of quantity items, or adding them to aggregating them together to align with the construction sequence and the timing for the and load it to the project schedule. It's important while we are doing the program or project schedule to maintain the estimation assumption. We used some productivity rates, some durations was considered there while we are doing the estimation assumptions. So all the things needs to be aligned together. We said the types of reserves. We have two types of reserve. One is the contingency reserve. We did it for the known risks. We know the risk, but we don't know if it's going to happen or not, because it's potential risk. So they call it known unknown, because we know the risk, but we don't know it will happen or not. The other type of reserve, it's called management reserve. It's added at the end by the management, and they call it unknown unknown. So we don't know even these risks, but we can expect from the experience of the management, may we have some things that's unforeseen and unknown now may happen. And based on this, we add the management reserve. And when we did the cost baseline and we did the alignment with the program or project schedule, we have this cost baseline curve, which is S curve, distributing the cost with time. And knowing what are the expected payments and cash in, we may have some funding requirements to do the project, and we add the management reserve also to reach the budget, and the actual expenditure can go in a different way, and if it is within range, we didn't overrun, we don't have budget overrun. It's very important to know the purpose of each type of reserve, because if it's contingency reserve, if this activity's duration already elapsed and we don't need this reserve, we can say it is closed and it will not be used. So it will be used only when this risk occur, and this makes the ownership and the authority to use. And normally for each risk, we have like risk owner. He will check the triggers, and he will be responsible to use this contingency or authorize the usage of this contingency. While the management reserve is extremely different. We don't need to mix between them and misuse the management reserve for other things. It's done only for, and can be authorized only by the management team. While we are, after we did the time cost linkage and we are now have cost loaded the program, we distributed the time phased budget. During the execution and implementation, we do cost control. We check what is the variance between the cost baseline, between the planned cost baseline, the planned curve, and the actual expenditures. Now we are doing cost control. We check this variance, what the reason and the root cause of this variance, to take the appropriate corrective action. We are doing these curves for the planned curve and the actual curve to visualize, to see where we are from the planned, or over budget or under budget. We need to check the remaining to achieve the delivery of the project, using the good planning and detection if we have any variance needs corrective action before we have like budget overrun at the end. And this, we can say, this is the main difference between accounting and cost control. We are doing cost control to have early planning and detection for any issue or any variance for the activities, not waiting to the end of the project to see if we are over budget or we have cost overrun or not. And we need to know the difference between the cash out, the expenditure, and the cash in. We get how we get the payments. Do we have advance payment? Do we need financial support? What are the timing of the money was spent? The different factors, we call it discount factor or discount cash flow, because the money was spent now in the present. The value of this money is different from the value of even of the same amount of money was spent on the future. That's why sometimes we need to convert all values when we are doing like checking the cash in and cash out, to do like converting everything to present or to future to compare apple to apple. One of the key things when we are talking about cost management and cost control, we need to compare apple to apple, compare something to a similar thing we have. Like if we need to, we cannot, when we are doing cash in and cash out, we are checking this to see if we need like financial or funding support or financial support, and checking our finance situation. But if we are doing cost control, we don't compare cash in and cash out. We compare cash out, the planned cash out, and actual cash out, to compare apple to apple. One of the main things as we said, we check the time value of money if we have something in present and future, converting everything also to the same timing. And one of the good things we have from ACE also the asset management, to check the whole life cycle of the asset and the cost, and we have international entities for this. For converting the cost to future and present, we call it time value of money and economics. And while also we are managing the cost, we have different terms we need to consider, like the foregone benefit or foregone project, which is opportunity cost, the sunk cost, the money was spent before, we don't need to consider in our future action. We need to consider the whole situation of the project. The book cost, some things recorded in the financial statements of the company, based on also it may include the depreciation cost of the assets, the incremental while we are comparing investments together, inflation, deflation, escalation, currency variances, all the things needs to be considered. Some of the things related to the market or to the economic situation and contract clauses. And here how to convert things from present to future, from future to present, or to convert everything to annual and compare things together. So it's very important in these discounting factors to convert everything to the same timing, to compare also apple to apple. Now we go to cost reporting, how we are doing the regular reports to be ahead of the game, to identify any cost overrun or opportunity to take proactive actions. While doing cost reporting, we need to see the current status and the expected things in the future. For a project, we can check the contract sum, the value of the contract, and if we have some approved or authorized expenditure. Any adjustment, we need to consider adjustments for the cost, adjustment for variations, for fluctuation. If the contract allows, all adjustments needs to be considered. The VAT and similar things, financial cost, if we have need to fund a project, all the things also needs to be reported and considered. The claims, if we have claims in place or upcoming or expected claims for payment or loss or expense or adjustment risk allowance. So we need to regularly report the status of the cost of the project until we reach the final account. So it's very important to keep reporting. We report to know the status, and based on this status, we can take the decisions. And this is the purpose of reporting. It's not reporting for the sake of reporting. We report to take the appropriate decisions. One of the things is to forecast what the remaining cost will be. Checking the cost, the actual cost with the value of work done. Checking the remaining work. The variance we have right now will affect the remaining activity, or the remaining activity can be on budget, or it will be extremely different, and we need to do re-estimation and recalculation for the remaining. We have different approaches for the forecasting, and we can find this in the earned value management. And as I said, all of these things we need to be proactive in mitigating anything and doing the appropriate corrective action. It's not only recording, it's to be move with lights on and take the appropriate corrective action. When we use the earned value management to do like the cost control, actually earned value management, it is a big topic. We have many references for this, stuff from ACE, PMI, APM, also specific references. We have one of the big references here from Fleming and Koppelman, and we have many references I used while studying earned value management. So it is not only 2-3 equations. It's a big topic. We need to consider like some how to deal with the changes, how to do the forecasting, selecting the appropriate forecasting approach, how to use it for time control, for scope control, for cost control, and sometimes we use different weightage and different types of calculations. If you can go to the main things, the core metrics of the earned value management is the planned value, earned value, and actual cost. As we said, after we distributed this this cost baseline with time, we have this curve of the planned value. So the planned value we are planning from the beginning. Then we do different work and we spend different money for this actual cost. And this is the problem here. Why this earned value is produced? Because we cannot compare the planned value and the actual cost, because we have different costs on different activities. That's why this term earned value is developed to how to be used to compare the planned and the actual cost. To be like coming in between, we can calculate the earned value to see the actually performed work and the implemented activities. What is the budget of these activities? So if you compare the budget of the executed activities or performed activities with the actual cost, now we are comparing the same activities and we are comparing the cost. So like this, we are doing cost control. And if we are comparing the planned value with the earned value of we plan to do this amount of the budget, but the activities we executed or perform the work performed is from the budget, it can be with this value, so we can know we are ahead or behind the schedule. So like this, we can do cost control. So it can be used to do time control or cost control. Cost control using cost variance and cost performance index, and time control using the schedule variance and the schedule performance index. Likewise, it can, in addition, we can use it for forecasting to check the estimate at completion. You can have here like a simple example. For the planned value, we call it budget cost. Planned work, we call it scheduled work. Work scheduled. Actual work, we call it work performed, and actual cost, we call it actual cost. And we have this activities planned, while actually first activity done on time, second activity delayed, third activity ahead, fourth activity delayed also. We did less than planned. Here we are checking the cost control, cost variance, and cost performance index and calculating the earned value. When we calculated the earned value, we multiplied this percentage of this percent complete of these three activities, and we got multiplied to the budget cost of them, and we got earned value of $10,000, while we actually spent $12,000 to execute these activities. This means the cost variance is the earned value minus actual cost. It is minus $2,000 over budget by 2,000. To see the percentage of this 2,000, we can find this by dividing earned value by actual cost to find it's 0.83. So we are 0.83 over budget. The challenges we have in the cost, the scope change. If we have scope changes in the scope, so we don't need only to have earned value to compare apple to apple. We need also to focus on comparing the same scope. So we need to overcome this challenge of scope creep or changes, and we can have here contract change management recommended practice from ACE. We can also checking the values we did and the work done on site, this cost value reconciliation. We can check the claims if we have some claims, and so changes and claims, all the things are affecting the cost of the project. So we need to check how we can overcome these practical challenges and keep comparing also apple to apple to do appropriate cost management. So now I'm like closing by mentioning what we can have also from ACE, this total cost management framework. It's a very beneficial and valuable framework we have from ACE, this total cost management. It is discussing the cost management, all processes we can do for cost management. We can see also from the CCP scale and knowledge the cost elements, all resources and cost elements, and everything affecting the cost. And one of the good things, they are not only discussing the project control, they are also discussing the asset management, the how to have the appropriate asset portfolio and to manage your asset, deciding the right projects and doing the projects right for project control, and considering the whole life cycle cost of the asset, of the material, of the project, of every item we are managing. To conclude, we discussed the cost estimation and how this participate to have a robust budgeting. We discussed also the cash flow and how to compare the cash in and cash out and financial management. And we discussed the project control, earned value management, the key items overall, and we also discussed the required consideration of the asset management and economics time value of money. So now I finished. I can go quickly again to recap and close the session for question and answer. So if you can quickly recap. I discussed from the beginning the the fundamentals of cost planning, to have a baseline, the importance of reporting and control, the risk and benchmarking, the estimation classes from 5 to 1, the groups of conceptual approaches and the detailed approach, the importance of checking the full details of each cost of every type of resources, labor, material, equipment, with consideration of productivity. And these references, the importance of having cost estimate report with all source of data, calculation, assumptions, and benchmarking. We discussed how to develop a cost baseline and robust budgeting with control accounts, the alignment with the WBS work packages, but from the translating the BOQ to schedule, with consideration of the estimation assumptions, the contingency reserve, the management reserve, and to align this with the time and to have the S-curve cost from cost loaded, schedule, and time phased budget to be used after that for cost control and checking the cash in and cash out and discounted factors, any financial management required for the whole life cycle, We checked how to checking the everything, bringing everything for the future or the present to compare apple to apple. The cost reporting, what should be the components of the cost reporting for any project with all adjustments and the current situation and the expected things in the future like claims or variations, the financial reporting, and we went quickly to the metrics of earned value, planned value, earned value, actual cost, and the analysis for the cost and time was one example how to check the status of the project from the earned value and actual cost, getting it's here cost variance over budget and cost performance index to see how much is it over budget. And finally, we check the practical challenges from the scope changes and claim management. And we went quickly through the main topics of total cost management framework from ACE, concluding the cost management to cost estimation, project control, assets, and economics as main topics. Any question?
Yes, thank you, Engineer Mohammed.
I see like
Yes,
few things
yeah,
also
we
in
will
the
open the
chat.
floor now for any questions. Can you hear me, Engineer Mohammed?
Yes, now it's okay. Yeah.
Yeah, so anybody from the team or the attendees can please go ahead and ask your question to Engineer Mohammed. Go ahead, please.
Assalamu alaikum.
Alaikum salam.
Can you please share the slides with us?
Yes, sure. Sure, I'll send
Thank
to the ACE and they can share with everybody.
Yeah, and I see an email, sorry, and like kind of inquiry in the chat from Lilia. So thank you very much for this information, detailed and useful presentation. If I may ask the following question, in my observation, the most construction project in Gulf region in terms of planning and cost are balanced by quite direct instruments such as prolonging the term of performance for non-positive additional year, commonly 1 year, with very often changes and updates in the project itself. What is your view? Would not it be more productive and efficient if the appropriate calculation estimation method for the project is used from the very beginning, in between brackets, taking into account the specificity of the project, the financing plan, and other factors? Could the proper calculation or estimation basis for the project from the very beginning balance the estimated term and cost for the project at the end, as well as determine the type of project cost management to be used for the very particular project? Can you elaborate more on this, Engineer Mohammed?
It is a long question and many questions inside it. I see here prolong the term of the performance additional year. Additional year, it means like you have extension of time or you are delayed by 1 year. And this like can be like one type of the risks you have and you need to consider in the beginning, or you may have the right to claim. So it depends. Sometimes and some projects, like we are going at the beginning of the project and doing like we did in one of the projects value engineering, and we advised the client to use different type of material. We can finish earlier, and in some cases in another case, for example, we proposed to extend the duration before we started the project. In the tender stage, we informed the client, if you extend this duration a bit, you can get a better price because this is compressed, for example. So I have like similar cases we can do from the beginning, and sometimes we consider if we get this project with this tight duration, you may consider you will finish later and add the risk of being imposed to the LDs and to the delay damages, for example. So all these things we may consider. I see also Wilson, any reference calculation management reserve, it depends on the company. They may add like percentage for also from benchmarking, like a percentage. They use to have like additional cost on the estimation. They have like 2-3%, even if they consider the risk. So, or 5%. It depends on the company. They add it in terms of percentage like this. Advance payment to reflecting cash flow. Yes, it's very important to have it in the cash flow, because you plan your financial requirements based on this. Because if you don't have advance payment, you need to pay, the company will pay and fund the project from day one. If you have advance payment, then you will see what will be the gap between the cash in and cash out and this funding gap, and then you plan your financial requirements according to this. So it's very important to consider this. That's why we normally, I said this quickly while I'm talking about earned value. Earned value, when we are doing like the planned value, we do sometimes our financial plan in our ERP system, for example, based on the cash out, and doing in the program based on the cash in as a contractor, because the cash in of the contractor will be the cash out of the employer. So we can share this with the employer, and the other financial things we don't share. And we can add the things, as I always say, apple to apple. If we are doing to spend this money in this way, I will add this in the comparing cash out with cash out in the same approach. So I can compare apple to apple and use this for managing my financial situation. So it's very important to consider this.
Okay, thank you, Engineer Muhammad. Another question from Malik. He's saying, in terms of advances paid and advances received, how, in your opinion, is the best way to reflect cash flows?
Yes, this I replied now. I see also another question from Malik. View of earned value. Right.
Hi, Mohammed. I have one question. Can you hear me?
Yes.
Okay. This is Anwar Kamal from Kuwait, senior specialist. I have a question related to your baseline area related to classes of estimate.
Yeah.
I need to understand when we says the accuracy range for level 3 is -20 to +30%. So what do you mean by this percentage? What this percentage give us the idea?
Normally, when you use this approach, the actual cost at the end will be with in a variance with this range.
This is, as I understand, we take as a reference for estimation purpose to report to the client that our estimate at the end of the feed is -20 to +30 class 3 estimate. So now we are not comparing with the actual cost. It is for the purpose of the bidding purpose, that the comparison of our estimate with the bids. So how this comparison will match with this percentage comparison?
Yes, at the end you need to decide 1 point of cost. While the cost is not only 1 point, it's a range. Right? Like you have like cost of anything, you have like the minimum and maximum in the market. So you have a range.
Yes.
But at the end you decide 1 point. And we have here also like this two things. It's also defined by ACE. We have the accuracy and the what we call like the possibility of happening or confidence of happening.
Definition. Yes, definition.
Right?
Yeah.
So here they are calling this range, it's range of accuracy. So you need not to like mislead your client. You need to tell your client this is not accurate. It will not happen exactly like this. It will happen in a different range. Based on different range, he can expect and manage his budget also. So he can say, yes, I can manage my budget based on this with expectation of this level of this percentage of increase or decrease. While in practice, we may have.
You mean while the minimum bid, the L1 bid will receive, the sole purpose for the client for the required class range of the accuracy from the consultant is for the bid purpose, for the management to authorize the budget based on the service request amount. So we set a budget that this is our estimate. We receive that percentage range. However, in case the L1 quoted by the bidders is far beyond our estimate, what does it means to us? What it give us the indications?
We have both situations. Sometimes we do like our estimate, and then we find all bidders are getting all bidders higher than this budget, and then we cancel the bid and we retender it again after we got the right budget or required budget. So it happens. It happens sometimes. You may have, normally when I have like a wrong plan, or normally when I want to mitigate anything or fix anything or have a problem in anything, it can be an issue in the estimate itself or an issue in the bidders. The bidders are providing higher prices because of some risk it is inside the contract or something like this. So if you fix this risk, you may get better prices. You may have wrong estimation from the beginning, so you need to recalculate and recheck your estimation. You may have a mistake in the estimation to fix this, because like this, you have in ACE many steps for review, to review an estimation. And you need to report everything as it's mentioned here in the lecture, and it's also very important to have many levels of review. Review by the math and calculation, review by the design team, review by the management team, review by the execution team, and final review by management team. So that's why it's very important to make like this. And as you mentioned, exactly, we have these situations, to reassure sometimes reassure a budget for the project, or we have some range for the estimation, acceptable range for the estimation.
Yes, thank you so much. But at the end, when the L1 is too far from the estimated, which was claimed earlier, for example, by consultant, that the accuracy is plus minus 15%. However, the range is reaching to sometimes 30%, the L1 or H1, whatever it is. So it does not give us complete or confidence in the accuracy range, which is defined by these class of estimates.
I see it happen.
Yes.
It happen, but it doesn't happen. It's common if you have good records, good historical records. Yeah, thank you.
Yeah, Mohammed, sorry, just because of the time constraint, we'll go to quickly.
Thank you so much.
Touch on one of the questions from. Thank you, Anwar. From Fadi, he's saying the current items we go through are having their effects on the types of risk a cost estimator should include in his estimate, or even with appraisal concerning war premium that could claim for lost time and inefficiencies. How could the appraiser estimator be able to capture these amounts in his estimate, and would be his basis of estimate and their effect on unknowns and level of work performance used?
Actually,
Muhammad, are you with us?
Yes, we have many risks. You need some experts also, and the risk, it's not only done by the cost estimator. The risk should be done like joint effort, and as I mentioned now, the cost to be reviewed by all these steps. Also, the risk needs to be joint effort and jointly collected from the whole team, like this. some risks we cannot provide against them, like this war or this force majeure. Normally, the risk doesn't provide against force majeure. This cannot be expected, or we cannot plan against this, because to plan against this, we will have very, very high values to be added and not necessary to be added, because this may not happen. But these things should be, we have like some mechanisms inside the contracts, and even in the law and the country will normally deal with these things, with these types of exceptional events or force majeure. And either it's we have clauses inside the contract, or we get some things from the country, some laws or something, how to deal with these things. That's why this cannot be included in the estimation.
All right. Thank you, Engineer Mohammed. Ali,
Assalamu alaikum.
go ahead, please. Sorry, go ahead, Mohammed. Yes.
I want to ask
If you have
my
a
question regarding
Mohammed, go
the
ahead, please.
my question regarding the contingency and the inflation. The inflation will be part of the contingency or separate.
No, the contingency, it is for the risk. The inflation, you have types. If we have here you may consider in the beginning, if you know the curve of these types of material, for example, or these things, how this will be affected. So you need to consider the timing. That's why the link between the cost and time is very important. You may have some seasonal cost of material, seasonal cost of labor. You have some material will be affected with time, and you have some inflation or fluctuation in cost. So all these things needs to be considered in the calculation. The contingency is the risk that may happen or may not happen. If these things you expect it's going to happen anyway from the history, so you need to consider like 100%. If things, it may happen or may not happen, then you consider with some probability. This is the contingency. So you have probability and impact, and then you translate this to cost.
It's clear. Thank you.
Okay. Thank you. Okay, Alim, we may present the certificate to Engineer Mohammed. Engineer Mohammed, as a kind of sign of appreciation, we really appreciate what you have presented to us today. For that, we are awarding you a certificate for presenting this to all the AACE members within the Saudi Arabia and the Gulf. Once again, we really thank you, and Hadim will be sharing with you the certificates soon.
Thank you. Thank you.
Thank you so much.
I appreciate your effort. Thank you.
Engineer Mohammed. And Alim, are you there, Alim, or not? You will be receiving with the link.